Thank you. Good morning, everyone. So I'm a portfolio manager and a partner at the Charlton Group, and I was asked to speak today, so I thought to myself, what can I say to everyone today that can add value? So I'm going to share some concepts with you that are life-changing. So quickly, some background first. Richard wrote a book called Investing the Billionaire's Way, and the foreword was written by Ned Goodman. So Ned and Richard were partners in a mutual fund company called Dynamic Mutual Funds, and Ned is a Canadian billionaire. Richard was also partners with Michael E. Chin. I don't know if that name sounds familiar, but next time you're at the Royal Ontario Museum and that structure jutting out of the ROM, well, Michael E. Chin donated $35 million to build that structure. So Richard and Michael immigrated from Jamaica to Canada with literally $1,000 in their pocket. And in the 1980s, they found a mentor in Warren Buffett. So for those of you that don't know who Warren Buffett is the third richest man in the world, and he owns a company called Berkshire Hathaway. Berkshire owns many different businesses that you are definitely familiar with. So Warren owns Dairy Queen in its entirety. Warren Buffett owns Geico Insurance. You ever see the commercials with the gecko? So Warren Buffett owns Geico. Warren Buffett owns Fruit of the Loom underwear, Benjamin Moore paints, 10% of Coca-Cola. So Richard really learned from Warren Buffett. He really taught us how to think about stocks. So when you think of the stock market, you think, oh my God, that's like gambling. I could lose all my money. You can if you invest in a certain way, but Warren really taught us how to think about stocks. Stocks aren't pieces of paper that you just trade in and out of. Stocks represent ownership in a business. So if you think about all the wealthy people in your community, they own a business. And you own a business for the cash flow. And the cash flow is what affords you a nice life. Alex? So Warren Buffett is known as the greatest investor of all time. And his total rate of return since 1965 is an outstanding 2,400,000%. So a good mentor to have is in Warren Buffett. Now, Richard was the architect of this fund. And back in 2001, Richard became very disillusioned with the stock market. The stock market was moving sideways for a couple of years. We had no growth. And I don't know if you remember, but there were lots of accounting scandals in the news, the Enron Scandal. An outrageous example was a chairman and CEO of Tyco. His name was Dennis Kozlowski. He was using shareholders' money as if it was his own piggy bank. He spent $6,000 on a shower curtain for his condo in New York. He spent $2 million on a birthday party for his wife. And that's when Richard said, you know what? When you find one cockroach in the kitchen, you move the stove, there's lots of other cockroaches. So from now on, I only want to own a business if it pays me a dividend every month. Then I will decide what to do with that dividend. I can use it to pay for tuition. I can use it to reinvest and grow my wealth. I can use it to pay down a debt. I can use the dividend to buy my dinner. So that's when we created Equity Income Fund. So Equity Income Fund was launched in July 2001, And some of the businesses that we own include real estate. So we own real estate all over the country, and we collect rental income. We own Rogers, TELUS. The Canadian banks have been paying generous dividends for the last 100 years. We own Cineplex. We own toll roads. We own A&W. So every single month, all the businesses that we own pay a dividend into the fund. So we use $1 million for easy figuring, but if you invested $1 million in July 2001, just sat there and reinvested your monthly dividend, your million is now worth $5,617,000. Now, we launched the fund in July, and then in September, the planes hit the building, and the stock market fell 20%. So, on the way from here to $5.6 million, you have to endure a lot of this. Emotionally, it's not easy. Otherwise, everybody would be rich. So I just want to share with you a quick 1-minute clip about Warren Buffett talking about stocks.
People think about it as they do some very silly things.
I mean, you lay this out in the annual report, but a lot of investors are told, retail investors are told, that they should have a certain percent of their portfolio in bonds. Maybe they're told 60-40, maybe they're told 70-30 stocks to bonds. That's something that you should do, and that's the safe way of doing it. What are they missing?
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock?
Yeah, selling a stock as it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, "I'll pay you 15," you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become. Whereas the longer the maturity of a bond, the more risky it becomes.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe.
Think about that analogy. So today you buy a house for $1 million. And tomorrow someone offers you $900,000. Would you take the offer? Of course not. So if you're a shareholder in Bank of Nova Scotia, and today you bought $1 million, and tomorrow the stock market is offering to buy it from you for $900,000, you shouldn't be a seller. Again, very difficult to do emotionally. How and why? This is life-changing. So why is McDonald's in business? Anybody? McDonald's is not in business to sell you hamburgers. McDonald's is in business to make the shareholder rich. Next slide. Coca-Cola. Coca-Cola is not in business to sell you Diet Coke. Coca-Cola is in business to make the shareholder rich. Every $1 million invested in 1968 with the dividends reinvested is now worth $200 million. Next slide. This very rich lady gave a gift to a university of $7 million, and she said to the university, "I will give you a gift of Coca-Cola shares with a stipulation. You can never sell the shares, but you can spend the dividend." So what's transpired is the $7 million gift of Coca-Cola shares is now worth $3 billion, generating annual dividends of $17 million. So the dividends you can spend, the capital we never touch. Suncor Energy. Suncor is a Canadian energy company. We own it in Equity Income Fund. And Suncor produces 700,000 barrels of oil a day. Suncor also owns all of the Petro-Canada gas stations. So next time you go to fill up your tank at Petro-Canada and you say to yourself, oh man, $1.50 a liter, you can say to yourself, all right, $1.50 a liter, I'm a shareholder and I'm participating in the revenue. Bank of Nova Scotia, $100,000 invested in 1983 with the dividends reinvested is now worth almost $11 million. Same concept. Be a business owner. Next time you go to a Bank of Nova Scotia ATM machine and you say, man, they're charging me $3 to take out my own money, say to yourself, all right, I'm participating in that revenue because I am a shareholder. I am a business owner in Bank of Nova Scotia. Now, I'll leave you with two things. When you're embarking on your career, think to yourself, what kind of business can I own that gives me reoccurring cash flow? So what I mean by that is, if you're a lawyer, the lawyer only gets paid if he invoices his client. The doctor only gets paid when they invoice OHIP. Spotify, however, charges you whatever it is, $10 a month, and that's $10 a month times millions of people. And the principals at Spotify, when they're sitting on the beach, are collecting that reoccurring cash flow of $10 a month. So that's an idea for you. I'll leave you with one last thing. So there were 3 men riding in the desert, and a big voice came out of the sky and said, get off your horses, pick up some stones. Tonight, you're going to be both glad and sorry. So the voice sounded ominous, so the 3 men got off their horses and picked up some stones. Later that night, they were around the campfire, and they remembered the voice. Oh, the guy said to pick up some stones. So the first guy reaches into his pocket and sees 3 emeralds. The second guy reaches into his pocket and he's got 2 diamonds. The third guy reaches into his pockets and he's got 4 emeralds. So the moral of the story is that they were both glad and sorry. Glad they heeded the advice, sorry they didn't pick up more stones. So guys, pick up stones. Learn everything you can about Warren Buffett. Go to all of the booths. Learn everything that you can from the representatives. Come to our booth. Ask for a copy of the book. Read the book. Pick up stones. Thank you, guys. Thank you.